News Talk 94.5 WPTI, 96.7 FM WTOB. You're listening to the Wealth Guardians radio show with Doug Ray, helping you to retire the job and keep that paycheck. I'm your host, Doug Ray. With me this morning is Brice Payne, and today we're going to be talking about some of the big, beautiful bill, some of the myths that are associated with this big, beautiful bill. How about that, Brice?
That's a good topic. A lot of misconceptions out there, a lot of unknowns out there, and the people want to just get a little bit of a sense of what does this big, beautiful bill really consist of. So we're going to go into that and debunk some of those myths. And in the second segment, Doug, we're going to talk about 4 things that you can control in retirement. There's a lot of stuff you can't control, but we're going to be positive and talk about the 4 things that you can control in retirement. So happy weekend to you, Doug. Get any football in?
You know, the Hall of Fame game, I watched a little bit of that, but mostly this weekend I got the grass cut finally.
Oh, there you go.
After all this rain. Didn't watch some of the Sedgefield tournament. That was good.
Oh, okay. All right. Very good. Well, I'm looking forward to some of these phony games, if you will, that are out there over the next couple of weeks. That's about the only time the Broncos are going to probably win anything. But let's see if the Panthers can win some games this year. Looking forward to the season. Absolutely. Doug, let's go ahead and do that Wealth Guardians radio service salute. Please take it away for us for that.
Absolutely. As always, we want to start this show out by thanking all of our veterans, our service members, and our first responders and their entire families. It's a sacrifice. We know it is. And we want to thank you for what you do for us. It's a calling for you. I understand it. But it's a huge benefit for us.
For everybody. Yep. Thank you very much. We appreciate it from the bottom of the Wealth Guardians' hearts here. And Doug, one other thing that we do before we get started into the meat of the show here is we ask ourselves a question so that everyone out there can better get to know their Wealth Guardians financial advisor. And the question we're going to ask ourselves this morning is, do we have any allergies? Doug, do you have any allergies?
You know, I got one in particular. I don't have too many allergies, to be honest with you. You know, due to all my my football and stuff I played, I've got a lot of arthritis going on. And there was this drug called Vioxx, which was like it was wonderful. I mean, it just did the greatest things for me. But then all of a sudden they found out it started killing people.
Oh, no.
Yeah.
Really? I hadn't even heard of this one.
Yeah. This has been a while ago. It's probably 20 years ago or more. And then, they took it off the market. Well, the doctor then prescribed Celebrex to me. I took one Celebrex tab and I broke out in hives and itches like you wouldn't believe.
Oh, is that right?
Oh my God. It was worse than I ever had an itch in my life, but it was all over.
Wow. Okay.
Yeah. So Celebrex, I can't take that.
Sometimes you got to figure it out the hard way. Yep. Yeah. Well, for me, aside from lima beans, believe it or not, I am allergic to hops.
Really?
Yes. I think you basically cannot have beer. So
seriously?
Yeah, seriously.
Beer.
You can't really have beer. It's have more than one beer and I start to get itchy everywhere. It's not fun. That's why I'm a whiskey and a rum guy. But that's okay. You know, as long as there's some other options out there for me. If beer was the only thing to drink, I'd be a pretty miserable guy.
You'd be in trouble.
Yeah. All right. Well, let's go ahead and get started on this. Segment 1 here, we're talking about the big, beautiful bill and the myths around it, and we're going to debunk some of those myths. So you've all heard the name, the big, beautiful bill out there. It's been in the news a little bit, and the big tax law changes always bring these big rumors. But before you assume Social Security is now tax-free or that you're getting a $40,000 deduction just for breathing, let's set the record straight on what this new bill doesn't actually do. Myth number 1, Doug, Social Security is no longer taxed.
Yeah, you know, like anytime they make tax code changes, there's going to be refinements, let's say.
Okay.
There's going to be a lot of refinements, and the IRS is going to come out and offer, further clarification as to what actually happens. So we all heard about no tax on Social Security. Well, I'd love it if that was true. However, what they've actually done in this bill is basically they've given you an extra standard deduction if you're over 65. So I think it's $6,000 for a married couple filing jointly, which their calculations say should eliminate tax on Social Security for something like 80% of those that are 65 and over. However, it's also income limited. So if you make over a certain amount of money, and I believe, don't hold me to this, further clarification is needed, right?
Right, absolutely.
I think it's $150,000 a year married filing jointly.
We'll put an asterisk by that number. Okay.
So yeah, like everything coming out of Washington, D.C., there's caveats to it.
So if you file, well, it doesn't matter if you filed for Social Security, right? It's simply age related. It's 65.
Yep.
Somebody could be 62 and have filed for Social Security. They're not going to get it.
Doesn't count.
Somebody could be 65, 66, 67, not have yet filed for Social Security. They're still going to get the bonus as long as they didn't make over whatever that amount is. Okay, very good. If you're just tuning in, you're listening to the Wealth Guardian Show with Doug Ray. And in the studio this morning is Doug Ray and myself, Brice Payne. And in this first segment, we are dipping into some big, beautiful bill myths, and we're trying to debunk them out there for you so you can have an idea of what this bill is really about and what it isn't about. And myth number 2, Doug, this new law means tax cuts for everybody.
Well, hold on your horses there.
Okay.
Not quite. As we just mentioned, the Social Security is capped by income. There's another one they brought back, SALT,
Yes.
which was the state
and local
tax provision, because they went from I think it was $40,000 down to $10,000 deduction, which really hurt living in the high real estate tax states like New York and California. So they brought it back to $40,000. Oh, whoopee, right? Wonderful.
If that's relevant to you.
Wait a minute.
Okay.
So this is age or income limited as well. So to me, it's kind of one of those catch-22s. If a SALT deduction is important to you, doesn't it also mean you're probably a high income earner?
True.
And if you're income limited, it brings it right back to the $10,000. So have they done anything?
Interesting. I hadn't thought of it that
for
way.
these high income earners in New York and California?
Yeah, apparently not.
I don't see it.
Okay. That's an
Maybe
interesting.
some folks will get it, but certainly not all.
That's a good point. Okay. If paying taxes, since we're talking about that, all this whole subject is about taxes. One of the things that we do at the Wealth Guardians, Doug, is a lot of people will think that as holistic financial planners that we help people with their portfolio allocation. That's one of the hats that we wear is investment advisors, right? But one of the other hats that we wear is tax mitigation. We help people understand what the tax laws are out there. It's great if your financial advisor, your investment advisor helps your portfolio grow. But if more than too much money goes to Uncle Sam of that growth, then what's the point, right? So one of the other hats that we wear at the Wealth Guardians is helping people mitigate their taxes so that growth that they're getting from their investments, they're keeping as much of it as possible for themselves. So that's one of the things that we do here. We are not just investment advisors. We are holistic financial planners, which includes tax mitigation strategies. If you would like to sit down with us, let's say that you're approaching retirement, and Doug, the tax laws change drastically in retirement. Once you don't have W-2 income anymore, and you are starting to take distributions from your accounts instead of contributing to your 401ks or IRAs, tax laws change dramatically. You're filing for Social Security. That's taxed in a very different way. If you would like to have a better understanding of that and see what we can help you do to keep more of your money from Uncle Sam, then give us a call, 336-391-3409. There is no cost to meet with us. There is no obligation to meet with us, but maybe you got to get in your car and drive to our office, but you go through a 4-meeting planning process with us, and essentially 100% of the feedback, Doug, that we get is, boy, this was sure worth our time from the people who've sat through that.
Yep.
So again, no cost, no obligation. If you'd like to sit down with the Wealth Guardians and see how we can help you plan for retirement in all the ways that has to do with tax mitigation and portfolio allocation, 336-391-3409. You can also reach out to us at thewealthguardians.com. Let's see what we can do to help you better plan for retirement. Let's get to the third one here, Doug, before we have to go to a break. The tax brackets are permanent now, so I don't need to worry.
Anything that comes out of D.C.
is not permanent.
Don't even think about it being permanent.
There's no such thing.
Yeah, I mean, the next administration coming in can change everything, and probably will. That's why we constantly have to study all these tax strategies and tax mitigation for our clients, because it does seem like it changes every couple of years.
Oh, it does. Absolutely. They're starting to use it really now as a tool to get more votes around election season. As we'll change your taxes more than this other party will change your taxes.
Now, when did they start that?
Well, yeah, I've picked up on it more recently, but it's probably been going on for a long time.
As long as I've been consciously aware of politics,
it's been a thing. But yeah, they're getting worse at it anyway. But you're right, Doug. There is no such thing as permanent. I think what they mean by that is, well, there's no phase out on this one, sunsetting on this these tax laws like there was on the previous one, and maybe that's what they mean by permanent. But it is not permanent by an eternal standard. It is going to change again at some point. All right. Well, we've got to get to a break here. And what do we do when we go to a break? We always have a trivia question. So, Doug, here's my trivia question for you. Are you ready? You're going to like this one.
Okay.
Are you ready? What NFL team out there has the fewest Hall of Fame inductees?
Ooh, okay.
Now, your team might have some of the most. The Green Bay Packers might have some of the most. But what team out there has the fewest Hall of Fame inductees? This is a logic question. There's a little bit of logic implied in this, so go ahead and think about it. And stay tuned for the rest of that trivia question. See if we stump Doug on the other side of this break. This is Brice Payne. With me is Doug Ray. The show's The Wealth Guardians, helping you retire the job and keep the paycheck. And this is News Talk 94.5 WPTI. And this is 96.7 FM, WTOB. News Talk 94.5 WPTI, 96.7 FM, WTOB. Welcome back to the Wealth Guardian Show, where we continue to help you retire the job and keep the paycheck. I'm Brice Payne in the Wealth Guardian studio, along with Doug Ray. And in this second segment, we're going to continue our discussion on Big Beautiful Bill myths debunked. I know we said that we were going to go into the 4 things that you can control in retirement, but we sometimes plan too much in here, Doug, and we got to kind of trim the fat around the edges of the shows. We just have too much to talk about, so we're going to keep talking about this big, beautiful bill. But before we get to that trivia question that we left Doug and you hanging out there with, let me ask you this. Are you planning to retire in the next 7 to 10 years? Okay, you probably are. Have you met with a retirement income certified professional who's also a fiduciary? If you have not, then here it is. I want to invite you to take us up on a complimentary review of your current retirement situation. As certified retirement planning specialists, we're going to put together a customized written plan with strategies for portfolio allocation, income distribution, Social Security filing, and tax efficiency, with the additional benefit of often reducing both the risk and the fees of your current plan. So if you put aside at least $400,000 and you want to take us up on this no-cost, no-obligation review, here's what you do. Pick up the phone and dial these numbers in this sequence, 336-391-3409. That's 336-391-3409, or go to thewealthguardians.com. That's thewealthguardians.com to learn more. Let us show you in black and white how to retire the job and keep the paycheck. We still say the term dial these numbers. It's not a dial anymore. It's push these.
I can't remember the last time
I dialed something. Right, exactly. All right, Doug, here is our trivia question. What NFL team, now that we've had the Hall of Fame game out of the way and now some of these preseason games are happening, what NFL team has the fewest Hall of Fame inductees in the Hall of Fame?
Yeah, this is a question that could be open-ended because, I mean, if you're talking about, are you talking about the original member of the team? Or are you talking about all the different variations of trades and so forth?
Oh, that's a good point.
I think logically you have to go back and think, okay, the 2 newest teams in the league probably have the least number. To me, that makes sense. That would be the Panthers and the Jaguars.
So there you go. All right, you got the Jacksonville Jaguars. You were using some logic there. That's right. And some of the other ones, the Carolina Panthers actually have 4, as does the Cincinnati Bengals. And the Houston Texans have 2, but the Jacksonville Jaguars have 0.
Yeah, I didn't think they did. Now,
because they're newer, you're right.
It was Peppers was inducted last year for the Panthers, right?
I'm not going to vouch for that. I don't
remember who the other 3 were.
I can't remember. I can't even remember who won the last Super Bowl. It was the Eagles, wasn't it?
Yeah, it was the Eagles.
Okay, but that's hard for me to remember that kind of stuff. All right. Well, hey, we got one. Good job, Doug. And let's go ahead and continue on here. Myth number 4. So what we're talking about is the big, beautiful bill and the myths around it, and we're going to help debunk those myths. So in the first segment, we talked about how Social Security really is still taxed, that the new tax laws do not mean cuts for everybody, that the tax brackets are not truly permanent. Here's myth number 4, Doug. A $15 million estate tax exemption means estate planning really doesn't matter anymore.
Well, sort of.
That's one of those questions that if you read it, you're like, well, I know this is a false if you're taking a test.
Yeah, I mean, obviously with $15 million per person, combine it to $30 million with a married couple, I mean, that covers quite a big estate. I mean, a business or a big farm, something like that. But that's the federal exclusion.
Right.
Doesn't say a thing about the state. All the states are different.
Right.
Not all of them follow federal guidelines. In fact, I don't think many do. North Carolina, for example, on your income tax return, all the North Carolina tax return is just an overlay of your 1040.
Mm-hmm.
But the estate tax situation is different.
Okay.
So you have to check whatever state you live in and see if what your estate tax ramifications are. There are some states that don't have an estate tax.
Oh, is that right?
Yeah.
Oh,
it's a handful.
Okay.
Not many.
All right. Let's move on to myth number 5 now. Car loan interest is now fully deductible. Boy, wouldn't that be nice if you had a car loan that was fully deductible? But there's some caveats around this one, Doug.
I think when I bought my first car, the interest was deductible.
Is that right?
Back in 79.
I didn't know it had ever been deductible before.
Yeah, even credit card interest way back when was.
I remember we had the cash for clunkers around the getting out of the Great Recession. Cash for clunkers. Yeah, I took advantage of that one. So the car loan interest is now fully deductible. That's not true. It really depends on what kind of car you got, and not just the brand of the car.
Yep.
But where it was manufactured, where it was finally assembled.
It's where it has to be manufactured.
It has to be finally assembled in the United States. But for example, you and I have BMWs. But our BMWs were not finally assembled in the United States.
Right.
They were finally assembled in Germany. But there are some BMWs that are just down the road here in South Carolina that would count for that. So you can't just look at the brand. You have to look at the exact model of the car. My question is going to be, is when you want to try to claim that deduction, are you going to have to show a receipt of what kind of car you bought?
Again, further clarification from the IRS.
That seems strange to me.
So it's limited to $10,000 in interest.
Okay.
And it's also income phased out.
Income phased out. Right. Okay. Well, if you're just tuning in, you're listening to the Wealth Guardian Show, and we're continuing our discussion this morning on the big, beautiful bill and the myths around it, and we're helping debunk those myths. So we got just a couple of more to go here. And Doug, the next one, myth number 6, I can skip itemizing and still get a huge deduction for giving to charity.
Good. Sort of true.
Kind of?
Yeah. It's an above-the-line deduction.
Okay.
And it's capped at $1,000 for a single person, $2,000 for a couple. It's still a good benefit, but it's not huge. So, above-the-line deductions are better than below-the-line deduction.
Explain what you mean by that. Well, when we say that, what is that?
Above-the-line deduction does not hit your marginal rate, where the below-the-line deduction does. So the above-the-line deduction comes directly off your income, whereas a portion of the below-line deduction comes off your income.
Roger. Yeah, a lot of people won't know what that means. Okay, so that's another one that is kind of a myth out there, though, yes, there is an above-line deduction, but it's capped, as you said, at $1,000 for singles and $2,000 for couple. Still a good benefit.
Yeah.
But not massive. Not massive. Okay. Let's go back for a minute, Doug, and talk about what we do at the Wealth Guardians for clients when it comes to
that. I want to talk about one other thing in the big, beautiful bill. Because it's
something that wasn't listed here. Okay.
Yeah, it is close to me. It's the Trump accounts.
Okay.
The Trump accounts are for babies born this year through 28. And of course, Harrison Ray was born.
There you go.
May 25th.
Garrett's son.
Yeah. So what is that? That is an account that is opened up for these babies, seeded by the federal government with $1,000. But anybody can put another $5,000 per year into these accounts. They grow tax-free. Now, further clarification is needed as to when you start taking money out for what, if they're going to be taxable
on the growth or
right. or
overall
tax-free. Could work kind of like a 529.
Yeah.
Here's the other caveat about these Trump accounts. Grandmas and grandpas, don't get your checkbook out right now. You're not going to be able to fund it till next year.
Oh, is that right?
Yeah.
Okay.
Yeah.
They can fund it. They just can't do it in 2025.
Right. They don't have anything set up yet. They haven't even funded the seed money for the baby's account yet. So
Okay.
apparently, supposedly, as soon as you get a Social Security number for the baby,
The account exists.
the account will be, it will be up and running.
Okay.
Let's say.
That's interesting. Of course, it's still to be determined how the money will be invested in that account. Can you, can you make those decisions, or is somebody else managing the account?
To be determined.
To be determined. Okay. Well, that is interesting. We'll see how that works out in the end for everybody. Let's talk for a minute, Doug, since we are talking about taxes here. That's what a lot of this big, beautiful bill was about, was taxes. What do we do at the Wealth Guardians? Give our listeners an overview of what we do for our clients when it comes to mitigating taxes.
Yeah, one of the biggest things you can do now in terms of mitigating taxes, and then you have to look forward to them installing this strategy. Roth conversions are huge.
Mm-hmm.
Are they there for everybody? No, they're not there for everybody. Not everybody should do them. But for the most part, you need to find out, will it benefit you? And the only way you're going to know that is to sit down and do a thorough planning session with a financial advisor or us. Obviously, that's who I'd prefer you to do that. But it takes a lot of digging to figure out if a Roth conversion is in your best interest.
A lot of math goes into that.
A lot.
Yeah, unfortunately, we have the software that helps us out with that.
Yeah, just don't go to a CPA and say, should I do a Roth conversion?
Right.
9 times out of 10, they mean well, but they're going to say no because it's going to increase your taxes.
Right. They're thinking in the short term.
They think in the short term. They're thinking about reducing your tax liability today.
Right.
They're not looking at 20 years down the road.
Right. And so, yeah, for anybody out there who doesn't get that concept, if you've got money in an IRA, that's pre-tax money that whenever you take a distribution from that, you're going to have to pay taxes on. Well, raise your hand if you believe Uncle Sam's going to raise taxes in the future. All right. So a lot of people in the triad just raise their hand. Well, what that means is if you keep the money in the IRA and whenever you take a distribution out in the future and Uncle Sam raised taxes, you're going to have to pay higher taxes on that distribution. But if you converted your IRA over to a Roth today, yes, it's a taxable event, but at today's tax rates. So now that it's sitting in a Roth, okay, you had to pay taxes on that, but now Uncle Sam raises the tax rates, has no impact, at least by today's laws, has no impact on that Roth account.
Yeah.
So there is a way to limit your taxes in the long run, but it's a tax hit in the short term. But that's what we do as financial planners, is help people figure out what's the best for them to do for the long game, the 20, 30 years that they're going to be in retirement. Mm-hmm. It's not just about what happens today or this year. And that's indeed what we do at the Wealth Guardians. And it's not just all about portfolio allocation, folks. That's great. Having a good investment advisor on your side is great. We do that as well. But tax mitigation is half the ball game as well. Keep as much of that growth from your accounts out of Uncle Sam's as legally possible. But that is going to use up all of our time today, Doug.
Pretty close to it.
Well, all right. Unfortunately, that is all the time that we have with you and that you have with us this weekend. We do thank you for joining us. We hope to see you back here next weekend. This is Brice Payne. The show is the Wealth Guardians. Doug Ray is here with me as well. And we want to remember, retire the job and keep the paycheck, and sound financial plans aren't going to create themselves. This is News Talk 94.5 WPTI. This is 96.7 FM, WTOB.
Hi, it's Garrett Ray with the Wealth Guardians. Thanks so much for listening to the show. Make sure to check out our weekly series, The Vault, on YouTube. Find our channel, The Wealth Guardians, where we talk about all things retirement planning and cover new topics each week, such as Social Security, tax planning in retirement, and our thoughts on investment best practices, and much more. New episodes air Thursdays at 2 p.m. Make sure to subscribe to the channel so you can get notifications when we release new episodes. We're here to help you retire the job and keep that paycheck. We'll talk soon.